Australians are increasingly using ETFs or exchange-traded funds to diversify their portfolios, with many investors using ETFs to gain access to the largest US stocks, the biggest global stocks, emerging markets, listed property and bonds, just to name a few. And as they're really cheap, transparent and as easy to use as buying a share, the industry has grown to $4.7 trillion. $56 billion of that is from Aussie investors, and that number is growing at a pace of 30% per year.
Indices like ours have become the backbone of the ETF industry because exchange-traded funds license our indices and then build portfolios to mimic the returns of those indices. And those vehicles are then available for investors to buy in a way that's cheap and transparent and very easy to use.
What other trends are you seeing from across the world?
I think the way to think of it is there are two prongs that are two causes that are leading to the effect you mentioned. One is that since the global financial crisis, which is now more than 10 years in the rearview mirror, equity markets have done very well. So we are in an extended equity bull market. Valuations may not be extremely stretched, but they're certainly higher than they were 5 or 10 years ago. So quite naturally, based on both the length of the bull market and the level of valuation, investors are, if not nervous, at least concerned or wondering whether this is a good time to take some equity money off the table. At the same time, as you noted, interest rates are very low, in some markets negative. And so the traditional way of becoming more defensive would be to do an asset allocation shift, move money from equities to bonds. And that's much less, or equities to cash for that matter, and that's much less attractive now than it would have been 20 or 30 years ago when interest rates were at more normal, what we think of as more normal levels. What that means is that there's been a burgeoning interest in what I would call defensive factor indices. A great example is low volatility strategies. So S&P 500 low volatility, S&P ASX 200 low volatility. What those strategies do is instead of owning the entire S&P 500, own only the least volatile members of the 500 or least volatile members of the 200. You get protection in down markets because typically the less volatile stocks go down less. And you also get participation in rising markets. If the market rises, the low volatility portfolios tend to go up.
So with the massive explosion and the increasing trend to use ETFs or exchange-traded funds as a way to access the market and build entire portfolios with simply one trade, could you just remind us about the benefits of using ETFs to gain access to certain positions, say for example, low volatility or infrastructure stocks, or perhaps even building an entire portfolio?
Because of the growth of the index business, it's possible to deliver exposure to a stock market, a bond market, a segment of a stock market, in a way that's cheap and efficient and transparent and doesn't require that an investor accept the risk of an active manager's stock selections. So for example, for Australians, if you want to invest in the Australian stock market, you can buy an ETF based on the S&P ASX 200. You get the entire market in one trade. You can trade it anytime you want during the day. It's cheap, it's transparent, it's easy. You know what you're getting. Same is true in the U.S. Same is true all over the world. So the growth in the index business, the growth in the ETF business have gone hand in hand. And I think the advantages they give investors are the elimination of stock selection risk. You take only the risk you want to take. You have only the exposure you want to take. Maybe I want the Australian market, maybe I want the high yield end of the US market, maybe I want China, whatever it is, there's very often an ETF that can deliver it to you. And as I say, they trade on the exchanges. It's as easy to trade them as it is to trade any individual stock. You can find out what they own because they have to disclose their holdings every day. So it's cheap, it's transparent, it's easy. It's not surprising that these have been so widely accepted.
And just before we let you go, you've previously spoken about the dangers of passive investing, and you've also done a bit of Google searching and your own researching. So Just tell us what you found in your research.
Well, this is actually kind of amusing, Jess. There is, as would naturally be the case, you have to understand that in the U.S., where indexing started, we have gone from 50 years ago, there was $0 in index funds, and now our estimate would be something like 20 to 25% of the entire U.S. equity market is held by index portfolios. One of the things that has done, I mean, many things it's done, it's been a lot of benefit for investors. One of the things that has done has been reduce the profitability of the active or stock selection focus, the active investment management industry. We estimated, in fact, it's kind of a rough estimate, but I think directionally correct. If you look at our main indices, S&P 500, mid-cap 400, small-cap 600, and go back 20 years and add up the cumulative fee differences that investors have saved by investing in those indices rather than in actively managed portfolios, the cumulative savings are something north of $250 billion, like $287 billion the last time we estimated. And that's just us. That doesn't include our competitors. So tremendous economic shift. Now, one of the responses that active managers have had to this trend, which has been massive, as I say, has been to try to suggest that maybe there's something dangerous about passive investing. And I think that's not true, but to give you a measure of how distorted things can become, if you go to Google and look up the danger of passive investing, and just look for Google News stories, I did this as recently as a week ago. I think you get something like 250,000 hits on that. If you then look for the danger of passive smoking, you get something like 50 or 60,000 hits. So if you looked at the news stories, you say, does anyone really believe that index funds are 4 times as dangerous as cigarettes that might actually kill you? I don't think so. But if you look at the stories, you might have that impression, and I think that's important to be aware.
Whatever you're looking for, there's probably an ETF for you. You just need to find it. So to do that, head over to Bell Direct's ETF comparison filter to find what you're looking for.